What if I told you that for most of your 30-year mortgage, you're barely paying down any debt at all? This isn't a conspiracy, it's just math. And once you understand it, you'll never look at your mortgage statement the same way again. Let's start with the most important concept in personal finance that nobody explains properly: amortization. When you take out a $300,000 mortgage at 7% interest for 30 years, your monthly payment will be roughly $196 every single month for 360 months. Sounds manageable, right? But here's what the bank doesn't highlight on that first page. Of that $1,996 payment, nearly $1,750, almost 88%, goes directly to the bank as interest. Only $246 actually chips away at your loan balance. By month 12, after a full year of payments, you've paid the bank nearly $24,000. But your loan balance, it's dropped from $300,000 to about $296,800. You've paid $24,000 and only reduced your debt by $3,200. This is the amortization schedule, a table that maps exactly how much of each payment goes to interest versus principal. Amortize comes from the Latin for to kill, and in the first decade of a 30-year mortgage, you are barely killing the debt at all. It takes until year 18, before the majority of your monthly payment finally starts reducing your principal more than it feeds the bank's interest income. The total interest on that $300,000 loan, by the time you make your final payment, you'll have paid the bank $418,327. That's $418,000 in interest alone. You borrowed $300,000 and paid back $718,000. This isn't predatory, it's just how compound interest works in reverse. The bank lends you money today, and time does the rest. Understanding this is the foundation of everything we're going to cover. Now that you understand how interest is eating your early payments, let's talk about the most powerful tool homeowners have to fight back: refinancing. Refinancing means replacing your current mortgage with a new one, usually to get a lower interest rate. And when rates drop, the pressure to refinance can feel enormous. But here's the math most people skip: the break-even calculation. Every refinance costs money. Closing costs typically run between 2% and 5% of the loan amount. On a $300,000 loan, that's $6,000 to $15,000 in fees, paid up front or rolled into your new loan balance. So the question isn't just whether the new rate is lower. The question is, how many months will it take before my monthly savings exceed those closing costs? If you refinance and save $200 per month but spend $8,000 in closing costs, your break-even point is 40 months. That's over 3 years. If you plan to sell or move within 3 years, you'll actually lose money by refinancing. There's another trap that catches thousands of homeowners every year: the rate reset trap. Imagine you're 5 years into your 30-year mortgage. You refinance into a brand new 30-year loan at a lower rate. Your monthly payment drops. You feel good, but you've just reset your amortization clock. You're back to year one, back to paying mostly interest. The bank wins twice. The smarter move, when rates drop, is often to refinance into a shorter term, a 15-year mortgage. Your monthly payment might not drop much, but you'll build equity dramatically faster. Let's talk about one of the most expensive mistakes first-time homebuyers make: putting down less than 20%. Private mortgage insurance, PMI, is a monthly fee charged to borrowers who put down less than 20% on a home purchase. It's not insurance for you. It protects the bank if you default, and it typically costs between 0.5% and 1.5% of your loan amount annually. On a $300,000 loan, that's $125 to $375 per month, every month, for years, and it does nothing to build your equity. Here's what makes it particularly frustrating: PMI disappears once your equity reaches 20% of the original purchase price. But the bank isn't going to call you when that happens. You have to request its removal. By federal law, under the Homeowners Protection Act, lenders must automatically cancel PMI when your loan balance reaches 78% of the original purchase price. But if you've been making extra principal payments and you hit 80% ahead of schedule, you can request cancellation. Getting an appraisal that proves your home has appreciated enough to give you 20% equity can also eliminate PMI, even if you haven't paid down that much principal. For buyers who can't avoid PMI, there are strategies to minimize the damage. Lender-paid PMI, a piggyback loan, or setting a specific payoff target. The key is never treating PMI as just a permanent cost of home ownership. One of the most important decisions in home ownership is one most buyers make in about 30 seconds. Should I get a 15-year or 30-year mortgage? The 30-year mortgage dominates the market because it offers lower monthly payments. But the true cost is staggering when you run the actual numbers. Take that same $300,000 home. At today's rates, a 30-year mortgage at 7% costs you $1,796 per month and $418,000 in total interest. A 15-year mortgage at roughly 6.5% costs you $2,613 per month, but your total interest paid is only $170,000. You save nearly $250,000 in interest. $250,000 just from choosing a different loan term. The 30-year crowd will argue you can invest the difference. That's $617 monthly gap between the two payments. And if you actually do invest it consistently in index funds averaging 8% annually, the math does favor the 30-year and total wealth built. But here's the behavioral reality. Most people don't invest the difference, they spend it. And the 15-year mortgage functions as forced savings. Every payment is building equity faster, and the clock to total ownership is half as long. For buyers who can afford it, the 15-year mortgage is one of the best wealth-building tools available. For those who can't quite stretch to the higher payment, there's a powerful middle path. Take the 30-year mortgage, but make one extra principal payment per year. That single extra payment can cut 4 to 7 years off your payoff timeline. So what can you actually do with all of this? Here are 5 moves that can save you tens of thousands of dollars. First, request your amortization schedule today. Call your lender or log into your mortgage portal and pull the full table. Look at how much of your current payment is going to interest. The visual alone will change how you think about your mortgage. Second, switch to bi-weekly payments. Instead of one monthly payment, make half that amount every 2 weeks. Because there are 52 weeks in a year, this adds up to 13 full payments instead of 12. On a 30-year mortgage, this simple change can shave 4 to 6 years off your loan. Third, make extra principal payments whenever you can. Even $50 or $100 extra per month applied directly to principal compounds dramatically over 30 years. Fourth, set a PMI removal reminder. If you're paying PMI, calculate exactly when your equity will hit 20% and schedule a request for cancellation. Don't wait for the bank to do it. Fifth, before your next refinance, run the break-even calculation. Total closing costs divided by monthly savings equals break-even months. If you might move before that date, don't refinance. Your mortgage will likely be the largest financial transaction of your life. Understanding how it actually works isn't just helpful, it's essential. The mortgage industry counts on complexity to keep borrowers passive, but every piece of math we covered today is something you can calculate yourself in an afternoon with a spreadsheet. If this breakdown changed how you see your mortgage, subscribe to the channel. We publish deep dives like this every week on mortgages, refinancing, and real estate strategy. And if you know someone who just bought a home or is thinking about refinancing, share this video. It might save them thousands.